Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Michael Bruff. Thank you, Mike, for joining me on our Fortuna Advisors podcast, Create More Value.
Hey, thanks, Greg. Happy to be here.
Michael Bruff serves as the CFO of Envision Healthcare, a leading national medical group consisting of a network of clinicians and clinical support teams. The company partners with hospitals, health systems, and more to deliver integrated care in emergency medicine, hospital medicine, radiology, anesthesiology, women's and children's services, and office-based medicine. Mike has more than 30 years of finance and operational leadership experience across various industries, including healthcare provider services, medical technology, computer hardware and software, enterprise software, telecommunications, and public accounting. Prior to Envision, Mike was CFO of healthcare services providers ChenMed and LifeStance. ChenMed is one of the nation's leading primary healthcare providers serving seniors, and LifeStance Health is a leading provider of outpatient mental health services. After initially overseeing traditional CFO functions, including investor relations, FP&A, and business unit finance, he became the CFO of Varian Medical Systems, a global leader in cancer care technologies and solutions, leading up to the company's record-breaking sale to Siemens Healthineers. Before that, Mike spent 19 years in domestic and international roles across finance and business functions at Dell Technologies, including as CFO of the Asia Pacific and Japan region. He started his career at Deloitte & Touche, MCI Telecommunications, before joining Dell. So Mike, starting at the top, you've been CFO of several companies, some public, others private, across different industries. What common threads have you seen? What does it take to be a good CFO, regardless of company type or size?
Yeah, thanks, Greg. And again, I'm super excited to be part of this podcast. Happy holidays to you and the team.
Thanks.
I had an absolute luxury of being the CFO of different industries, and when I'd say different capital structures, whether it's public, private, or founder owned. And while the investor or the cap table may change some of the motives of investors, I really found that the fundamentals of the chair of the CFO are consistent. I believe there's several common threads that I've found valuable over my time. I'll share with you 5 of those. First is having a really strong foundation in internal controls. I know it may sound not as sexy as so many other things out there, but I grew up at Deloitte & Touche in accounting and auditing, where you documented workflows, you looked at controls, and in the early 2000s when Sarbanes-Oxley came out, it even became more important. So I think having that foundation, whether you get it in public accounting or you work in an internal audit function in a company, I think is really going to be helpful for anybody aspiring to be a CFO. I think the second thing is having a breadth of functional experience within the CFO organization. So, I had an absolute privilege, and I really do believe I had the privilege of working for Dell Technologies for 20 years. Over those 20 years, I don't think I was in a role longer than 2.5 years. They moved me around quite a bit, a lot of it by design to develop me as a leader, but often out of necessity, and they weren't afraid to do it. And so having different perspectives within the CFO organization has helped me as a CFO when I've had to make decisions. And I'm talking to the head of corporate planning, I'm talking to the head of accounting. I can share with them my experiences and why I'm making that decision. So it gives you a little bit more credibility. The third thing is having operational experience. Again, back in my time with Dell, I'll cite 2 things. One is, even as a business unit CFO, sitting in quarterly business reviews, it was very common to have an executive leader direct an operational question at you. And we were held accountable to operating results just as much as the operating leaders. And some thought that was unfair. But really, what it was is it's developing you to be much more than just a financial brain. And
Mhm.
Delwyn went so far as to move me into an operating role, where I was in a COO type role for their North America business, running sales strategy, sales planning, business operations, and it was 2 years, great experience. I think the fourth thing I'd call out is probably one of the most obvious, and that is really having a solid understanding of the interdependencies of all three financial statements. And I think we see all too often companies over-index and get enamored on the P&L. They
Mhm.
spend the majority, if not all the time, thinking about growth and profitability. And I think as CFOs, it's our responsibility to look at all of the financial statements, think about growth, profitability, liquidity, capital structure,
Mhm.
capital efficiency, capital deployment. And so I've had to create space in monthly reviews and quarterly reviews to have these incremental conversations with management teams that were, perhaps a little bit more indexed on the P&L. And I think the
Mhm.
last thing here that I'll share with you is, um, the CFOs are in a unique position to work with whatever administrative body it is inside of the company, to influence what gets discussed in business management systems.
Mhm.
We monitor the operations of the current business. We think about the financial performance, but we also need to develop tactics and strategies about the future and how we're going to deploy capital and assessing
Mhm.
investment opportunities. So, being involved with business management systems, I think we're in a unique chair to do that. So those are the 5 things I call out, Craig.
Oh, that's really great, and they're all obviously very important. The one I find some people don't value as much as you just did is the operational experience. I really do feel that if you've only spent your entire career in finance and you haven't spent any time actually in operations, maybe even in an operating role, leading a P&L, it's very hard to oversee people that are in those roles. So yeah, I think that experience is very important. But I like the breadth of your 5 points. It's very good. So we met when you were at Varian Medical Systems, which was a great success story, during your tenure. In fact, for those who don't know, there's a special issue of the Journal of Applied Corporate Finance I happen to have here that was issued in honor of Fortuna Advisors, and there's an article about the case of Varian Medical Systems, which Mike thankfully co-authored with my partner Marwan Karame, which is a very good article if anybody wants to read it. But in any event, what can you share with the audience about what it took to turn what was already a great company into a great stock? I mean, the stock was a bit floundering when you got there. What were the big changes
Yeah.
that caused that?
Yeah, Greg, look, and I think you said it was already a great company, and I think it's important to reiterate it was a great company, 70 years old, great CEO and Dow Wilson, great
Mhm.
operational leadership team underneath him, that had built that company to 60 to 80% market share in radiation therapy across the world. And yeah, over the perhaps prior 5 years, the growth was kind of in that 0 to 2% range. Obviously, not what they wanted, and it put a lot of pressure on management from the board, from investors. How are you going to grow earnings dollars? And so the focus really became on margin expansion, or if not, buy back shares. And
Mhm.
buying back shares became a strategy. And
Mhm.
all other things being equal, if you buy back shares, your EPS is going to go up. And lo and behold, you nail the EPS expectation that investors expected because you gave them that expectation. It's
Right.
a self kind of fulfilling prophecy that they had laid out. The other thing
Mhm.
that they did, to meet that kind of short term EPS target, was they cut R&D. You're cutting expenses, and so we had to take a really hard look at how we were deploying capital and how do we get top line growth ignited. How do we increase value in the company and drive stock price? And with the help of your team, Greg, at Fortuna, we took a hard look at how we were deploying capital. It became super clear, like very,
Mhm.
very quickly, that when we invest in R&D, we generate a return on invested capital of 25, 30, 35%, which is way above investor expectations, which was around 10% at the time.
Mhm.
So we had to really think about capital deployment and R&D as capital deployment. and not as an operating expense that you cut to hit an EPS number.
Mhm.
So when we started thinking about it that way, we developed a framework again with your team called Varian Value Add. We called it BVA for short, and it treated R&D as a capitalizable cost. It sat on the
Mhm.
balance sheet for us when we were thinking about investment. So we couldn't cut it, when we were thinking about generating cash earnings. And so we deployed this framework at a macro level to look at how the company was generating value period to period. But what was super exciting was deploying it at the micro level. And at the micro
Mhm.
level, we looked at existing investments, we looked at new investments, and that really opened up this kind of avalanche of ideation from
Mhm.
our program management, product development groups, because they said, "Hey, we're capitalizable. This is how we create value." And
Mhm.
when we brought all those ideas together into our strategic planning framework, we were able to use this VVA methodology to make very quick decisions because it was crystal clear that if we made
Mhm.
these investments, we would generate long-term value for the company, even in an environment where that investment might bring down EPS.
Mhm.
So,
Mhm.
all of this, it took us, I'd say a better part of, 6 to 9 months to really work through the methodology, get it deployed, then drive
Mhm.
it through our strategic planning process, come out with a new multi-year plan. We shared it with investors in 2019. I think there
Mhm.
was some renewed enthusiasm,
Mhm.
with the investments that they saw in R&D, even though it declined EPS in maybe the first year, but they saw the corresponding returns in outer years. And look, that attracted a lot of attention, and as you said, it culminated in that sale to Siemens Healthineers in 2020.
Yeah, a lot of what you said is really resonates from having been through the experience with you. The one thing I want to emphasize, though, that you said, which has come up in several different calls where people talk about versions of economic profit that they use, and that was that you can quickly make decisions. I think that when people see a new financial measure, it seems complex to them. Once people understand it, and you have a single measure that captures growth, margin, and the use of capital in one measure, when either goes up or it goes down. The trade-off is much
It's
easier
simple.
than when you've got six different measures that capture different parts
Yeah,
of the scorecard. And I think that speed of decision making was really evident back then. And I think that's something people should take away from your experience.
happy to share a great experience on that if we have time at the end. I know it's a pretty interesting one.
Actually, no, why don't you go into it now, just while we're on the topic?
Yeah. Yeah, look, while we're at Varian, and at the time I was in investor relations and FP&A, and I was working with Gary Bishoping, who we both know. He was the CFO at the time of Varian. The company was looking to expand into different markets. It was a strategic fit, et cetera, et cetera. And we made a greater than $1 billion bid on a company in Australia. And we used the VVA model, the variant value add model, to determine that the price point that we were willing to pay generated value for our investors over time. It was going to be a
Mhm.
short-term hit to EPS, and as we got it retooled, but it was crystal clear on the value creation. About 3 days before the final vote on the other company's side, another company came in and offered 25% premium to our price. And I will
Mhm.
never forget walking into an office with Gary, the CFO, with Dow, the CEO, and we literally had a dry erase marker. We went up to the board. It took about 10 minutes for us to calculate that if we went in and met that price, it would not generate value for investors. And it was a very quick calculation. It was a very quick decision, and we stayed true to that methodology, because a lot of companies will say, "Oh, we've already invested our time and we can make this
Mhm.
work," and we didn't. And I give a lot of credit to those two gentlemen for making the right call.
Yeah, I think it was very impressive. I remember in the moment being impressed with how quick the decision was made as well. And I think it's very different from what happens in a lot of company situations when something like that occurs. You've invested a lot of time and effort and emotion in the fact that you're going to make this big strategic acquisition. And then when the rug starts to get pulled out from under you, the natural reaction is to figure out what can we do to save it. And often that means jacking up the price. And for people that are not using a framework like this, they're using a traditional NPV analysis. A little tweak of the growth rates, can get you a little more NPV, and before you know it, you're making this big bid that's overpriced. I think when I've studied acquisitions, as I've done numerous times throughout my career, most acquisitions create value. It's just that people pay too much more than half the time, and that's why many of them destroy value for the acquirer. And I think you guys just exercise great discipline in that situation to really treat the company's capital like it was your own. So Varian was quite capital intensive, both in terms of traditional capital expenditures, but also the large, R&D innovation spending that you talked about before, which you did treat like an investment in the metric, which I think really helped with the decision making. But not all the companies you've been part of have been traditionally capital intensive. What are the differences in terms of business management in a capital light versus a capital intensive type of business, and what's the same?
Yeah, it's super interesting when I get in these conversations. I hear a lot of arguments around um, residual cash earnings framework. So, hey, this is really for capital intensive companies where you deploy a lot of PP&E, property, plant, and equipment, and big manufacturing facilities, laying out capital expenditures that, go out a long time that have returns, that may not come in for 10, 20 years. I suffer the argument and argue back. And I
Hmm.
really, I don't necessarily focus on the differences between the traditional capital intensity and non-traditional. I really focus on the similarities, and that's where I go. And the
Hmm.
similarity to me is very, very simple. It is, number one, you have to understand what is the value driver or drivers of a company.
Hmm.
And in a lot of companies, it might be that you're going to deploy traditional capital to build a new manufacturing site in an area to open up a new market. That makes a lot of sense. But in other spaces, such as Varian, R&D is not a capitalized expense. It was an
Hmm.
operating expense. So we had to think about that as a capitalized expense. And then so you have to understand your value driver. And then the second thing is you have to be able to identify all the capital that's being deployed, no matter where it sits. It may sit on the balance sheet traditionally in PP&E. It may sit as an operating expense on the P&L. And you have to
Hmm.
pull all that stuff together because those costs, the dollars that you're spending, those are the investor dollars that you're spending, and those investors expect a return. And so I think
Hmm.
if you look at it in that way, then these things become similar, even though traditionalists, people, will think of this more in the capital intense environment. But
Hmm.
when I think about the time, um, in healthcare provider space, there's not a lot of capital intensity or property plant equipment that you're deploying. Maybe a little bit for building out a new clinic,
Hmm.
where you're going to outlay a few $100,000 for some improvements, but you could just simply be contracting services. And so
Hmm.
then you start thinking about capital intensity of, okay, maybe I want to stimulate growth. Well, how are you going to stimulate growth? Well, maybe it's you haven't been growing for a while. You need to make investments in marketing or brand or in sales teams, and okay, well, that's new investment. How do you think about that? That is new
Hmm.
costs that your founder, your public investors, or your private investors are going to have to deploy. And even if you get, if you want to argue that, at the end of the day, if you do end up growing, all other things being equal, accounts receivable is going to grow, and that is a
Yeah.
usage of working capital. So
Hmm.
as you're thinking about those investments, you've got to think about deploying working capital in AR. And so pulling all these costs together and understanding what investors expect from a return, you have to clear that hurdle in the cash earnings, that after tax cash earnings that you make.
Hmm.
And so again, to me, it's just finding the capital that you're deploying, the cash, the dollars that you're deploying, no matter where they are on the financial statements. That's the important point. And I think all too often folks fail to realize that capital is not just confined to BP&E.
Mm-hmm. Yeah, no, that's really, really well said. So, what about transformative investments, especially those on the P&L? How do you think about such expenditures?
Yeah, look, there are different schools of thought here. And it really depends on industry norms on how you treat transformation costs. And when I talk about treatment, it's like where do they exist in your financial statements? And so transformation investments, they typically have to clear a hurdle of strategic fit, execution risk, et cetera, but also do
Hmm.
they deliver attractive return? And
Hmm.
when I think about, I'll kind of talk about two different schools of thought here. At Varian, in the med tech industry, transformation investments were included in the P&L. And so they impacted your adjusted earnings, your adjusted EPS statement. So it was
Hmm.
incumbent upon us to be transparent with investors on what those investments were. And with the VVA framework that we deployed there, we were able to provide them with supplemental information about those investments and then how they generated a return. So
Hmm. Hmm.
again, at Varian, the costs were included in the P&L. In the space where I am today in healthcare, the provider space, those transformation costs or strategic initiatives, often those costs are excluded from adjusted earnings. Now, if they're excluded from adjusted earnings, the cash is still going out the door, so you don't see it on the P&L anymore. You have to go hunt for it. So you're hunting over in the cash flow statement to look for that cash being deployed. Regardless, you're still going to have to provide transparency to your investors. You're going to have to identify that. And then you're going to have to provide some supplemental information connecting the dots. So transformation costs can be treated differently industry to industry. At the end of the day, it's incumbent upon the company to be transparent with investors, to have that dialogue, to show how value creation is being measured and get that alignment. Have alignment on the go, no go hurdle, whether it is
Hmm.
the return or versus other alternatives, and be able to share with them some supplemental information to see how this all connects the dots. But at the end of the day, we're making investments that are going to generate a return. You just got to be able to show it.
Yeah, I think that's really good. I think that too often EPS focused people just view that like an event that didn't even happen. That's free money.
That's
And
right.
you never make the right decisions when you think of it that way. So thinking about it as something that not only has to make strategic sense, but has to earn a return is a great way to look at it, of course. So to change the topic a little bit, as you know, episode 47 of this podcast featured Patrick Furtaw on the subject of pricing strategy. And across the companies you've helped lead, what has been your experience with pricing and what are some of the process shortcomings you needed to fix?
Well, look, pricing is both simple and complicated at the same time. To
Hmm.
me, and really, the RCE framework, it makes it simple in my brain. And the simple part is determining the minimally acceptable price, which generates value for an organization. So, once you identify that, then your goal is how do I get the highest possible price point over and above that?
Hmm.
And the complex part is that piece. And so I've seen two methodologies deployed. The given across both of these methodologies is that a company will have a set of existing customers, and in that set of existing customers are a variety of gross margin or margin profiles. Some with high
Hmm.
margin, some with low, and the average of all of that is the gross margin that sits on the financial statement. So
Hmm.
methodology one says, hey, I'm going to set a pricing governance that will not allow sales organizations to price below that average without me coming in and approving it. And that's
Hmm.
one way to do it. Often, what I find is it de incentivizes sales organizations for bringing in opportunities that are below the average in profitability, but are well above value creation floor. And so
Hmm.
often I see that those opportunities are missed because we're striving for a percentage. And a great CFO of mine in the past used to say, "You take dollars to the bank, not percentages."
Hmm.
And
Hmm.
so look, the second methodology really is the one that I think about. I think it works, which is you understand what that floor price point is that generates value, and you incentivize the sales organization to drive the highest price point through sales quota retirement, sales compensation. If they hit a margin percent space that looks and feels right for this type of customer, you pay them dollar for dollar. If they can
Hmm.
sell at a higher price point, you pay them, 1.1, 1.2, 1.3 times that. If they have to sell below to win, you offer point 0.9, point 8, point 7 times their sales quota retirement. It's
Hmm.
complex in laying that out. But to me, I would rather see the entire suite of opportunity and make decisions than set an artificial barrier of where we are today and miss out on value creating opportunities that are below that. So that's the way I think about it. And in prior companies, we deployed the second version there, and it was quite successful.
That's really great. I think you hit on a number of good points there. I'd like to emphasize. One is getting away from corporate or finance approval and getting toward having a system that gives people more local authority, but with accountability, is a better way to make sure that the right decisions are being made. Oftentimes, if you just inject yourself in the process, then people just deals go away, as you said, that might have
That's right.
otherwise been considered. Let's not go bother Mike with that. He's probably going to say no. I'm not going to waste my time. And there are deals that would have been approved that don't happen because you never see them. So I think
Yeah.
decentralizing authority and accountability is often a great way to get good decision making. And I think getting away from a hard boundary and instead of having like kind of a continuous scale that if you can get some upside, you're gonna get a disproportionate share of that upside shared with you. If there's downside, you're going to share some of that as well. And this way, if they see that if we make this deal at a lower price, it's going to get us into this customer, and it's going to make other sales later on that are going to be at full price very valuable. They can do that, but part of what they're investing in that future is their own money. Because of the sliding scale. So yeah, I think that was really well done. I like that approach. On a different topic now, you've been champion of planning processes that separate run the business from change the business, and which I've always loved. And first of all, where did this come from, and what are the benefits of this type of planning?
Yeah. Look, this is a framework which was used at Dell. It was derived from, I think, a Bain planning methodology.
Hmm.
The funny thing is I really didn't appreciate it while I was at Dell because I was working within it, not deploying it. And when
Hmm.
I got to Varian in 2017 and was running corporate planning, working with Gary Bishoping, we decided, hey, we need to deploy this because we need to think about new investments and things like that. And when you think about this, run the business and change the business, to me it is very much aligned to kind of lean thinking, which is run the business, or RTB is really who you are today. It's the day-to-day business that you're running, you're monitoring. It's the run rate of the business over time. And then you have this other thing called change the business, which is really a process that can take in this new, chunky, iterative strategic planning. It requires business cases, governance
Hmm.
gates, and it's just very different motion and time spent than just running the day-to-day business. So a lot of companies will try to do these in one meeting, and all too often you'll get indexed on one and not the other. So we
Hmm.
segregated the at Varian, and it worked beautifully. We deployed the process. Changed the business was really where we were using the RCE, Varian Value Add framework, to look at new investments. And it really kept management's attention on those new investments outside of just monitoring the day to day. So keeping management focused and efficiency on time, pedal down on the velocity of the current business, but having those deeper conversations on change the business, that was a great benefit. The other benefit was it forces you to evaluate value creation of the current business that you're in. And what I mean by that is all too often companies will say, well, this is who we are today. So next year we're going to be that. Now let's look at some new things. And what this
Mhm.
this framework says is, wait a minute, you have to actually look at your current business and evaluate that business to make sure it's generating the returns that you want in and of
Mhm.
itself, but also relative to new opportunities. Because you might end up eliminating a current investment because there's a better opportunity to create value with something new.
Mhm.
So this
Mhm.
framework drives that. And then the last thing I think from the benefit is it's simple math. Run the business plus change the business equals where you are going. And if you don't
Mhm.
like the answer, then go back to both of those and evaluate the investments. And do you have opportunities to close the gap from where this is pointing you to where you really want to be?
Mhm. Mhm. Yeah, I mean, one of my pet peeves about planning processes is they very often are just extrapolations of the past. And I think on both fronts, you're obviously the change the business side of things. You're trying to make sure people are thinking about what new are we going to do. But to run the business, having that as a separate focus, like it is, you'll make sure people are constantly trying to improve it, not just taking it as a status quo. So I
That's
think
right.
that's a really good point that you've made. So let me go to another question, which I think is very relevant. So, what has been the general level of financial acumen outside the finance department at the companies you've been part of? And you don't have to name any specific company in this regard, but what have you experienced, and what can be done about it? Because this is one of the things that I find finance people often complain about is that the people around the organization don't get it. Um, what's been your experience?
Yeah, look, my experience is it kind of follows the culture of the company. And if a company demands that financial acumen, you'll typically hire for it in development and sales organizations. I think, and I'll be super complimentary. I think Dell's sales organization had a very good financial acumen, but they also invested in folks like me to build
Hmm.
out training programs to go out and meet them out in the field and train them on that. And it was generalized. What I really like when I was at Varian and we deployed VVA, we were able to take some very simple examples and go out and talk to the sales organization. We were talking to operations, talking to manufacturing, and taught them in the simplest of terms how their role actually created value for the company. And
Hmm.
and when you can break it down into something that's a simple and relevant to the individual and his or her function, then it goes a long way. And
Hmm.
so ever since we really did that VVA work at Varian, I brought those really simple examples like the laundromat, and brought those to folks, and the light bulb just goes off, Greg. You just see it.
Hmm.
And we
Yeah.
had one of those sessions earlier this year in Denver where we brought together the top 40 management, and we kind of walked through it, and you just see light bulbs going off. and
Hmm. Hmm.
and people get afraid of, oh, finance, and, oh, what's the margin, how do you calculate this? But at the end of the day, if you just make it so simple that they understand that it's real life, you're just acting like you normally would in your own home.
Hmm. Yeah. Yeah.
It just makes it simple, and people make the right decisions that way.
Yeah, no, that's great. I think that's a good description. I think it is an important thing that cannot be ignored. I think that there are organizations where the level of, I'll say, business acumen, even not even financial acumen, where people understand the sort of quantitative side of decision making, is lacking outside the finance organization or even in the finance organization. But let's leave that aside. And sometimes they accept that as that's how it is. And I think it's one of the important levers to get, like, you can't decentralize thinking like the pricing example you gave before without a certain amount of understanding in those people, and you don't get those all those benefits of the they're giving people authority if they don't really understand how to use it. So I think that's a really good point. So we've been speaking with Mike Bruff. Thank you, Mike, for joining us for this very important conversation.
Thanks, Craig. I appreciate the time and the opportunity to be with you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.